Before the collapse of 2008, the world believed housing was a safe bet. Homes, they said, never lose value. Banks, investors, and governments all trusted this simple truth. But beneath that stability, a storm was brewing. A storm built on greed, blind trust, and financial engineering. And when it hit, it would ripple across every corner of the globe. This is the story of the subprime mortgage crisis, the decisions that created it, and the people who unknowingly or willingly fed the fire. After the 2001 recession, the US Federal Reserve cut interest rates to historic lows. Borrowing became cheap. Banks needed more loans to generate profits. At first, traditional lending standards applied. But soon, banks realized they could make more money lending to riskier borrowers, packaging these loans into securities and selling them worldwide. Subprime mortgages, loans given to people with poor credit or unstable income, became a golden opportunity. Why? Because they could bundle hundreds of these risky loans into mortgage-backed securities, slice them into different levels of risk, and sell them to investors with top ratings. What could go wrong? Rating agencies gave AAA ratings to securities that were far from safe. Banks and investors bought them by the billions. Pension funds, hedge funds, insurance companies, and even foreign governments poured money into these safe assets. The world believed in stability, trust in numbers, trust in models, trust in institutions. But the models were flawed. They assumed housing prices would never fall nationwide. They assumed borrowers would keep paying even in a downturn. And most importantly, they assumed that no single failure could cascade into global collapse. All these assumptions would be proven disastrously wrong. Financial institutions were no longer content with merely holding mortgage-backed securities. They leveraged their positions, borrowing tens of billions to increase returns. Leverage is simple in theory. A small investment can control a massive amount of assets. But it's a double-edged sword. If the market moves against you, losses are amplified, often catastrophically. Lehman Brothers, Bear Stearns, AIG, and other institutions became intertwined in an invisible web of risk. Banks were not just lenders, they were traders, insurers, and speculators. The system was fragile, complex, and opaque. And yet, confidence was sky high. As long as housing prices rose, everything seemed fine. By 2006, housing prices were at all-time highs. Speculators, investors, and even first-time buyers rushed into the market. Loans were given without income verification, sometimes without proof of employment. These risky loans were repackaged into complex derivatives, sold globally, and insured with credit default swaps. The global financial system was now betting billions on the assumption that the US housing market would never fail. It wasn't just money at stake, it was trust. And trust can vanish faster than capital. In 2007, the first cracks appeared. Subprime borrowers began defaulting. Housing prices stagnated and then declined in certain regions. Investors started realizing that the AAA-rated securities were far riskier than advertised. Banks that had leveraged heavily began to face massive margin calls. Liquidity dried up. Some institutions collapsed quietly. Others managed to survive, barely. But the system had been stretched too thin. Every new default increased pressure on a network of global financial institutions. By 2008, the crisis became undeniable. Bear Stearns collapsed in March, rescued by JP Morgan Chase with federal intervention. This was a warning, but the world ignored it. Lehman Brothers, heavily invested in mortgage-backed securities, failed to find a buyer. No government bailout came. On September 15, 2008, Lehman filed for bankruptcy. Panic spread like wildfire. Interbank lending froze. Stock markets plummeted. Money markets, the lifeblood of global commerce, evaporated. Millions of ordinary people lost their homes. Jobs disappeared. Pensions were affected. Entire communities suffered. And yet, few of the decision makers faced personal consequences. The disaster wasn't caused by one person, one bank, or one law. It was a systemic failure, the inevitable outcome of risk mismanaged at scale. The subprime crisis exposed uncomfortable truths. Complex financial products can hide massive risk. Leverage amplifies both profits and losses. Trust is fragile and often misplaced. Greed often outweighs caution. The 2008 mortgage crisis reshaped global finance. Governments intervened, regulations changed, banks were forced to recapitalize. But human behavior, that is harder to regulate. Even today, echoes of the subprime crisis remain. Complex derivatives are more sophisticated but still risky. Leverage still exists in hidden corners of the financial system. Housing bubbles can recur in other countries. Trust remains the most fragile currency. The subprime mortgage crisis is a warning. Unchecked greed, poor oversight, and misplaced trust can destroy even the most stable-seeming systems. And it's a lesson the world must never forget. The subprime crisis didn't happen overnight. It was built quietly, allowed to grow, and then exploded, leaving devastation in its wake. The question is no longer if history will repeat itself, but when. Welcome to Cash Chronicles, where money, power, and history collide.